Hi, I'm Michael Ruger. I'm the managing partner of Greenbush Financial Group, and today I'm going to be going over with you retirement withdrawal strategies that we use with our clients. Often when retirees get to retirement, they have all these various retirement accounts of different sources like Roth IRAs, they have pre-tax accounts like their 401ks, IRAs, they might have cash or after-tax brokerage accounts, and the question becomes, if this is my pool of money I have to work with, what's the right strategy as far as taking a certain amount each year from this pool, that pool, to essentially, and the goal is to minimize taxes over the long term, which by minimizing taxes and drawing from the right sources, it allows your retirement assets to last longer. It helps you avoid any missteps, because if you take big distributions from pre-tax retirement accounts, it can cause your tax liability to skyrocket. It can cause your Social Security to be taxed at a different rate. It can cause your Medicare premiums to increase. So all this stuff that retirees have to be careful of. And also, if we maximize the retirement assets long term, it may leave more left over for your children and beneficiaries when they pass on to the next generation. When we talk to clients about building a withdrawal strategy, it's very similar to building a house. We have to start with a foundation amount of income, and then we build up from there. And some retirees still have pension plans, which we know we're going to have. Let's say it's $50,000 per year coming from a pension. That becomes a foundation. And pension income, it's normally subject to federal income tax, but depending on what state you live in and who your employer was, it may or may not be subject to state income tax. So we always have to say, if we have 50,000, that's kind of the starting block before we start making withdrawals from these other sources. The second layer of the house is Social Security. So many US citizens are going to have Social Security when they retire, and many are also very surprised to find out that you have to pay federal income tax usually on those Social Security benefits. So it's money they took out of your paycheck, but then when you receive it in retirement, about almost up to 85% of that Social Security benefit can be taxed at the federal level. So we have to factor that in, saying if we've got pension, then we have Social Security on top of it. And the Social Security, when you file, can actually factor into the withdrawal strategy. And I'll put a link to one of our videos about Social Security filing strategies, but just kind of know that by not taking it early at age 62, your Social Security benefit increases by about 6% per year until you reach normal retirement age. And then at normal retirement age, it starts to increase by 8% per year until age 70, where it maxes out. So if you think about this in the financial planning world, we look at those bump ups as almost a guaranteed rate of return, because we know if we're waiting an extra year to turn on Social Security, we're gonna get that 8% increase, which we can't get an 8% guaranteed rate of return really anywhere else. So where this factors into the withdrawal strategy is we'll look and say, hey, if we've got all these extra assets to draw from and we can delay Social Security, maybe we do that knowing we're going to get that general increase. Besides just the increase in Social Security, there are also other benefits to not taking your Social Security early, such as it could lead to a larger 50% spousal benefit for your spouse. It could lead to a higher survivor benefit should you pass away, and it reserves a higher dollar amount for your spouse, because when a spouse passes away with Social Security, it's only one Social Security benefit that survives and moves forward. Also, think about it. If you have a larger Social Security amount because you delayed, it's actually less money that you need from your other sources going forward. And then the fourth piece is Social Security has a COLA, a cost of living increase attached to it, meaning they look at inflation and say, hey, your Social Security benefit is going to go up by 2% next year. That COLA does not happen on any of your other retirement assets, so it's a big benefit, and it's just another, these other factors factor into whether we take Social Security early, later, and use other assets as part of that withdrawal strategy. Now that we've built those first two layers of the house of income, which is the pension and Social Security, now it really kind of opens up, because now, okay, we've got those pieces, but now it's Roth, pre-tax, after-tax sources. Where am I pulling money from? Let's start with Roth. Not because Roth is the first source you draw from. It's actually usually the last. And the reason why Roth, if you have Roth IRAs, it's usually the last source you touch, because it's one of the most valuable retirement sources. Mainly because all the accumulation, as it continues to accumulate, is withdrawn tax-free in the future. So we almost want those Roths to grow as long as possible, because that tax-free benefit continues to build. In addition to building a bigger piece, a bigger accumulation that's going to be withdrawn tax-free, also there's no required minimum distributions at age 72. So pre-tax retirement accounts, the IRS forced you to start taking these small RMDs or required minimum distributions at 72 and paying tax on them. Roths do not have that. So you don't have to take withdrawals. They keep building and building and building. And at the end of the day, if you have all these assets and your kids or your beneficiaries have to inherit something, Roth is usually the most beneficial source for them to inherit, because under the new beneficiary rules, if it's your spouse, they can roll it over to their own Roth and continue to accumulate tax-free and make withdrawals tax-free. If it's a non-spouse, they basically have 10 years that they could let it accumulate for another 10 years and then withdraw it all out in year 10, and they don't have to pay tax on it either. So again, if there's money left over, usually Roth is the best source to pass on. If we're not withdrawing Roth, then that leaves us obviously with pre-tax and after-tax sources. Which one do we go with? So with pre-tax sources, and these sources have never been taxed before, like pre-tax 401ks, 403bs, 457 plans, traditional IRAs, rollover IRAs. And the way these work is as you draw money out of them, that's when you pay tax on those amounts. And typically you're going to pay federal income tax on those distributions when they happen. And depending on the state you live in, you may or may not have to pay state income tax. But even for states that have income tax, there are some exceptions for retirement accounts you have to be aware of, and they vary state by state. So an example is we're based out of New York. So if you're a New York resident and you start withdrawing money out of pre-tax sources, New York has a special state tax stipulation that the first $20,000 that you take out of a pre-tax source, you don't pay state income tax on. It's only the amounts over and above that $20,000 in a given tax year. And every year you have that $20,000 to work with. So that factors in the withdrawal strategy that if we say, hey, we've got two spouses, we can withdraw $20,000 each out of their pre-tax IRAs, pay federal tax but no state income tax. That can often factor into withdrawal strategy saying, hey, let's tick away at these things before we have to hit those big required minimum distributions later on. These pre-tax retirement accounts are those sources that are subject to those required minimum distributions, those RMDs that I talked about with the Roth section. So when you turn 72, if you have pre-tax retirement accounts, the government actually forces you to start taking distributions out of those accounts in pieces because they want to realize some of the tax revenue by you taking that income. So if you think about it, if I retire at 60 and I've got, let's say, $500,000 in a pre-tax IRA, if I don't touch that and it continues to grow until age 70, and let's say it's $1 million by the time I'm 70, my RMDs might be $40,000, $50,000, $60,000 per year. And by putting that amount of income on the table, again, the adverse consequences is, Medicare premiums are income based. It could bump up your Medicare premiums in retirement. It could make your Social Security tax at a higher rate. It could make that $60,000 or $70,000 tax at a much higher tax rate. So sometimes the strategy is saying, instead of waiting until 72 and taking these huge RMDs, let's project out and say, maybe we take $30,000, $40,000 a year from this traditional IRA, realize it in these lower tax brackets, so by the time we hit age 72, the RMDs are not at large and we'll realize it at a lower tax rate over a longer period of time. The final source being the after-tax source, which this is really cash savings, after-tax brokerage accounts. It could be cash value and permanent life insurance policies. And retirees that have this after-tax source just give us some planning flexibility, because we can almost pick your tax rate in any given year. Because if you come to us and say, hey, my expenses are $80,000 per year, and you have, let's say, $200,000 in your savings account, if we wanted to, we could take it all out of the savings account and you could have zero taxable income for the year. We delay Social Security and all that other stuff. We normally don't do that because the idea is if I've got after-tax money, pre-tax money, I want to find that right fit. So we usually work with the accountants and say, okay, if they have $80,000 expenses, maybe we do the 20 and 20 from the traditional IRAs, no state tax on that, and very minimal Fed tax, and then we take the other 40 from the after-tax account. So we have to just try and figure out what the right blend is. Let me give you a real life example of how this works. So let's say we've got a retired couple, Jim and Carol. They're 65, they just retired. Between the two of them, let's say they have Social Security of $40,000 that they get combined, and their retirement expenses each year are $100,000. So they're going to get $40,000 from Social Security, but we have to reduce that for taxes again because they're going to pay tax on it. So we got to figure out where the rest of the money is coming from to get them up to the $100,000. Now let's say their assets are $500,000 in a traditional IRA, $100,000 in a Roth IRA, and let's say it's $200,000 they've just got in cash sitting in their savings account. Now in this situation, what a typical solution might look like is saying, okay, well, we've got 40 in Social Security, we'll take 5 out for taxes, so that gets us 35, but we need to find the other 65,000 to get them up to 100,000. Usually we'll meet with their accountant and say, okay, they've got these pre-tax accounts, they're New York residents, so let's at least take the 20,000 each out of the IRA. So 20,000 a piece gets us $40,000. We have to take Fed tax out of that. So let's say after tax, 35,000. So now 35,000 after tax Social Security, 35,000 after tax from their IRAs. That gets us to 70. Now the other 30,000 either has to come from additional money out of their pre-tax accounts, or we're just going to take that from their cash holding of 200,000, and most likely maybe that after-tax account or some combination of the two of the IRAs are realized at a fairly low tax rate. Again, we're probably leaving that Roth IRA alone because we just want that thing to keep growing as long as it possibly can, and then that would be essentially the last withdrawal source. Another situation that we run into is common is when retirees have all of their retirement assets in a pre-tax source. So it's not uncommon to have accumulated everything in a 401k over your working years. You don't have any Roth, you don't have any after-tax assets. But the thing about everything being in pre-tax is it's a little bit trickier from a planning standpoint, because we realize if we incur any big one-time expenses in retirement, it all has to come out pre-tax, which means you're going to pay tax on all of it, which means some of those adverse tax consequences we were talking about that are income-based, it says, some of the tax credits and tax deductions that you get when you file your taxes are income-based that you could lose if your income's too high. Medicare is income-based. Your Social Security taxation is income-based. So by taking larger unexpected distributions in a single year, it's not just a tax liability, it can be a domino of other things that happen, and you don't find this out until you go to file your taxes the following year. So one of the common situations we also run into with everything pre-tax is it's not uncommon for retirees to want to buy a second house in retirement, saying I'm going to retire, I'm going to do the snowbird thing back and forth. But if everything's in a pre-tax retirement account, it's like, how do we tax efficiently come up with a down payment of $60,000, $70,000 and not pay a huge tax amount? A lot of times we have to plan ahead multiple years to say, hey, we either have to have a plan 5 years in advance as to where this down payment's coming from, or we have to start taking smaller distributions out of these pre-tax accounts to start accumulating the down payment that we know is going to happen in year Y. And a lot of retirees don't like the idea of taking on debt retirement because they're trying to reduce their expenses, which makes sense. When we talk about the second house situation, some people will come to us and say, hey, want to buy this $200,000 condo? Should I just do it? I don't want a mortgage. I'm just going to take it all in my pre-tax retirement account. And then we remind them, by taking $200,000 out of a pre-tax IRA, you probably have to take 280, 290 because you're going to have a ginormous tax liability because you're showing all that income in a single year. So in those situations, it does typically make sense to take a mortgage, because by taking a mortgage, yep, we have the down payment, but then we can take smaller IRA distributions and pre-tax distributions over the course of 10, 15, maybe even 30 years, where we never bump you up into those higher tax brackets. The third withdrawal strategy that we often use with retirees that have pensions and Social Security. So they have pension and Social Security, and they say, hey, those two sources are enough to meet all of my expenses, but I do have these other retirement accounts that I don't see myself needing or using. They're probably going to end up passing the kids. what should I be doing with these in retirement to maximize, the tax liability and also the type of assets my children are going to inherit. In a lot of these situations, we use a Roth conversion strategy. So what we say is, if you keep accumulating these pre-tax assets, well, remember, the IRS is going to force you to start taking distributions at 72, which you definitely don't need, and you're going to have to pay lots of tax on, because you're going to have your pension, you're going to have your Social Security, and then they're going to throw the RMD up on top of that. Instead, maybe we think about doing Roth conversions where we're intentionally moving money from your traditional IRAs to your Roth IRAs each year. It's a taxable event, but once it's in the Roth IRA, all that accumulation from that point forward is completely tax-free to you if you ever needed it, but more so to your beneficiaries when they inherit it. If they keep accumulating the pre-tax source and you pass the pre-tax source on your beneficiaries, they're gonna have to pay tax on all of it. And due to the new non-spouse beneficiary rules, they have to take all of that pre-tax money out within a 10-year period. So again, most beneficial asset for people to inherit is a Roth. So we kind of say, how do we start pushing more money over to the Roth source, which will help you avoid those big RMDs and pass assets on in a more tax efficient manner. And we might be able to take advantage of a lower tax bracket if you're in a potentially lower tax bracket because you're retired, as opposed to where your children would be paying tax on those sources. While these Roth conversions in retirement can be a really effective wealth planning tool, I just want you to be aware of two things. So first, when you do a Roth conversion, the money goes directly from your traditional IRA to your Roth. You need a source to pay that taxes, because if I move 20 grand from traditional to Roth conversion, that is a taxable event that I might have to come out of pocket a few $1,000s come tax time, but I didn't have the money because it moved directly from the traditional Roth. So a lot of times you have to have an after-tax source, or you have to be willing to take a distribution from a pre-tax account to end up paying the taxes. So you have to be ready for the tax liability. The other thing I'll mention about these Roth conversions in retirement is long-term care events are happening more frequently because people are living longer, we're becoming more frail in our older ages. So when a long-term care event happens and people end up in what's called a Medicaid spend down, they've tried to protect all their assets, but the idea is, okay, I got to spend down my assets, and then Medicaid picks up the tab for the expense of long-term care. Roth IRAs cannot really be protected from a Medicaid spend down event, which makes them kind of vulnerable if that event lies in the future. So while people can use irrevocable trust to protect houses and other non-retirement assets, and while traditional IRAs, if there's a long-term care event, you only have to commit the RMDs, you don't have to spend it down. Since Roths don't have required minimum distributions, 100% of those accounts, at least in New York, are subject to the Medicaid spend down process, so they can be depleted pretty quickly if there isn't a plan to deal with the long-term care expenses should they come along. If you have any questions, please feel free to reach out to us at moneysmartboard.com. Thank you.